Hey, everybody, and welcome back to another week of Crunching Your Growth. I'm your host, Phil Masiello, and today's conversation is one that I think founders, entrepreneurs, growth minded investors are really going to appreciate. I had a conversation. The guest today is Michael Monaghan, but I had a conversation with him a couple of weeks ago, and he was talking to me about his business, and he was saying that founder-led companies. We'll get into this, but I'm probably going to butcher this, but I'll say it anyway. But founder-led companies that are public perform better, and so he's got a whole business built around this. And of course, it got my brain working. And I haven't used that part of my brain in quite a while. I got my master's in finance, and I just haven't been in marketing for 25 years, so I haven't used that part of my brain. But he brought something out in me, and then I had to go research it, and it was very interesting. And I think the reason I wanted him to come on the show is because I think for all founders and entrepreneurs and again investors, I think it's just an interesting subject. And he'll get into it. He'll explain it a little bit more. But he's a right now, he's a portfolio manager for the Founders 100 ETF, which is what I'm talking about, also known as FFF. And he spent more than, I think, 2 decades in financial services, investing across full life cycle, founder-led businesses, early-stage ventures, mature public companies. His background includes roles at Goldman Sachs, Sanford Bernstein, UBS, private market experience with Carlyle, Riverstone, but what makes his perspective, I think, interesting is that he's also been in the founder's seat himself, having built and led a brand called Bartooth Radio, a defense technology company, for more than a decade. So we're going to dig into what makes these founder-led businesses different, why they often outperform, and what Mike's learned from studying the traits of the entrepreneurs who build these companies. And that's where I think the learning for our viewers is going to be. So I think this is a conversation about leadership, vision, resilience, and the kind of growth that doesn't happen really by accident. So let's bring him in. Michael, thanks for taking the time to come on. I really appreciate it. I hope I didn't butcher the intro too badly, but really, welcome. Thanks.
Thank you, Phil. I really enjoyed our last conversation and even more excited to meet some of your viewers on Crunching Growth.
Yeah, it'll be great. So why don't you take us back a little bit about your history, what you've done in the past, how you got to where you are today, a little bit about Beartooth, and that I thought that was an interesting story about how you started that, and then let's get into FFF.
Great. I sort of break my professional life up into 3 acts. So the first act, I was fortunate enough to work at a firm in New York City, Goldman Sachs, during the height of the original .com. It was very exciting. We took 2 companies public a day, so two IPOs and a secondary a day for almost 2 years. So it was a very high velocity, getting to learn about all of these new companies that were being brought to the public markets. So really an exciting time to be in the public markets. So that was Act 1. Act 2, I left that business. I had inspiration. I was skiing in 2012, actually with my college roommate, and we lost each other skiing up at Bridger Bowl in Bozeman, Montana, and we got to the base at the end of the day, and we said, well, how neat would it be if we could make these things, smartphones, connect directly without any cell service? Well, we thought it would be a short endeavor to build this product, launch this product, and everyone would want it. Well, 3 years and $3 million later, we launched our first product. We got it into the markets. We learned some of your skills, that is marketing. And it was really an exciting journey. We also learned that it wasn't just a consumer product. It ended up being something that was relied on by the most elite tactical teams, whether those be high-level federal law enforcement, defense. And so we ended up transitioning from what we thought would be a consumer product to a defense technology. We were kind of OGs in defense tech before it got hot.
Yeah.
We're serving the people that serve us, and we're really glad that we created a product that helps them. So that was Act 2. And then Act 3, and then I'll pause and we can get into some more discussion back and forth with each other. But Act 3 is we've created the Founders 100 ETF, ticker FFF. And the reason we wanted to do that is that founders are special in the amount of value creation that they give to their shareholders. It typically has been reserved for early stage investing for the venture capitalists.
Yeah.
We built a public market portfolio that captures all of the excess alpha that founders bring. And I'll just share one statistic with you, and then we'll get into some of our data. But there's a Bain study from 2014 that looked at S&P stocks from 1990 to 2014, and the founder-led S&P stocks delivered 3 times the stock performance of non-founders. So it's a really efficacious place to go fish. So we're in the market. We don't necessarily think that we're smarter than the market. We just want to fish in the best parts of the market.
Yeah, that sounds interesting. I read after we talked that time, I was so intrigued. I grabbed the study and I read it. And again, a lot of statistics and a lot of data in there that I haven't used in, 35 years or so. But it was great interest. It was quite interesting, and I thought it was great information. And so how do you go about doing it? Like, what are you looking for? Because there's more than 100 founder-led companies out there.
You're right. Over the last 30 years, which was sort of the data sets that we looked at, on average, there's about 800 to 1,000 founder-led companies in the stock market at any one time. To generate the 100 that we own, we start with the 200 largest by market capitalization. And then both my partner and I come from a firm called Sanford Bernstein that used to build factor models. And so we build a fundamental-based factor model that we believe selects the 100 best out of the 200 largest.
So, so companies like Apple would fall out once Steve Jobs was gone, correct? Or
Correct. So once the original founder, so in the case of Apple, Steve Jobs is no longer with the company, so we don't own Apple. Last year, prior to the public launch of the fund, I was running the strategy in my personal accounts, and so when Mr. Buffett announced that he was leaving Berkshire, we sold out of our Berkshire position. So when the original founder announces their retirement, we sell the position on the announcement of retirement. So if they announce it in May, saying they're going to leave in December, we sell in May.
Interesting. So what do you think the difference maker is? You've been entrenched in this for a couple of years, and you've obviously studied it. What do you think the difference maker is?
So there are some qualitative attributes of founders that we believe generate the qualitative outperformance. So those qualitative factors include the fact that founders tend to be visionaries, they're charismatic, they execute relentlessly, and that charisma and execution allows them to marshal a team of people to accomplish missions. They're typically mission-driven as well. And so that adds up to being able to deliver better products, understanding their customers better, and it generates better stock performance. Often, looking at the financial statements of these companies, on average, they have higher revenue growth, higher earnings growth, higher free cash flow margins, and they operate under net cash versus net debt.
Now, do you think that when the founder leaves, does the company continue for a period of time to achieve the same sort of performance metrics that it did prior? So let me give you an example. So when Steve Jobs was gone from Apple, do you think that the metrics held for a period of time and then fell off, or do you think they just sort of fall off? I guess another good one would be Uber.
Yeah, so let's do Uber, and this is my opinion. I think Dara is actually one of the great non-founder CEOs. So I'm going to first really compliment Dara. He's done a great job, but Uber's a roughly $100 billion company. If Travis Kalanick was still running that company, it'd be a $1 trillion plus company. It's just the difference between the way a guy like Travis has vision and execution and a really good board-hired CEO. So in that case, there's probably an entire order of magnitude of performance difference between What Dara has done, again, Dara is an incredible public company CEO. Travis would just bring a different level of execution and performance.
Wow. So who do you think the top 10 founder-led companies are today?
So obviously, Jensen's doing a great job at NVIDIA. We own NVIDIA.
Right.
Mark's doing a great job at Meta. Getting out of tech, because let's kind of do some non-tech just so that people understand this is across the entire economy. We think Rich Fairbanks at Capital One is doing a great job. Monster Beverage is a great founder-led publicly traded company. So we see a bunch of them. Blackstone and BlackRock are still founder-led. Larry Fink and Schwartzman, and so across the entire economy, we see great founder-led companies. Closing out your question from before, on average, right? We look at really large data sets. We're trying to build a large market
Sure.
portfolio. On average, as soon as the founder announces that they're leaving, stock price does not perform as well as before. So either the growth decelerates or you actually see a decline in stock price performance.
Yeah, I love I love the CEO of Capital One, or the founder of Capital One. I think that he had a great vision for what he wanted to be and how he wanted to put it all together. And again, he thinks of himself as I read an article about him, and he thinks of himself as a retailer, not a banker, but a retailer first, or a consumer marketer, I guess is a better way of saying it. I don't know if that's true or not. It was just an article that I read about him, but I do like him. And I do like the way he's sort of put that whole business together over time and how he's really kept that brand in focus.
Yeah, I think that how a lot of founders think is they're very customer first. They've got a product development mindset, how they approach the customer's problem. We often say we don't view ourselves as an investment management company. We do manage investments. We really view ourselves more of a product development company who understood what the customer needed, and that was the best possible way of compounding their wealth at the best risk-adjusted way. And when we looked at 30 years of data over 11,000 stocks, we saw that building a broad market portfolio of founder-led stocks accomplished that goal, tying all the way back to our end customer.
Yeah. Yeah, it's interesting. I tell people, when people ask me all the time, just because they think that I know some things, which I really don't, but they ask me all the time about investing in AI. And I always say the same thing. If you're going to invest in AI, invest in NVIDIA, because every AI needs their backbone. So you're going to benefit from it, because you don't know. It's sort of like the Wild West right now with AI. You don't know who's going to survive, who's not, who's going to succeed, who's not. But NVIDIA is always going to, you know, because they need that backbone.
We agree. We think there's a lot more room to go in NVIDIA. And the second piece is we think all large publicly traded companies that survive and thrive will have an AI aspect.
Sure.
Meaning the competition is getting so stiff, and the need to automate and your systems and make them efficient. There's going to be a heavy AI component embedded into each of these, and it won't be the companies that say they have an AI task force or AI this. It's going to be the people that actually automate their processes in a highly efficient way.
Yeah. I I think people. I actually wrote an article about this not too long ago, because it brought to mind. I remember when Circuit City, when they were still around, they had laid off in one day all their high paid people, and thought that they could exist with salespeople that were making minimum wage, and it almost killed the company. Well, I mean, it did eventually kill the company, and then I was equating that to what we see with AI, where people are going, okay, well, we implemented AI, so just start firing people. And I agree with you. I don't think that's the way to do it. I think you have to have a some sort of a plan for what you're going to do with AI, how you're going to use AI. AI is a discipline. It's not an app. It's a discipline for how you're going to achieve efficiency and what channels you're going to use to gain that efficiency. And I think people misunderstand it and start thinking, okay, well, we implemented AI, we can get rid of the accounting department because now AI is paying the bills.
I think that's a great way to frame it up, and that's the way we see it, is that AI is a tool that makes your most effective employees or engineers even more effective. So it seems unlikely that you're going to get rid of your entire team. But what it's going to allow you to do is make your most effective people even more effective.
Yeah, I agree with that. I think that it's, for what we've done in our small company, it hasn't cost any jobs. What it has done, though, is taken away the mundane tasks that nobody likes doing, and we can automate that so that we can focus on what's really important, which is growing our clients' businesses.
Absolutely. We see the same thing. We used AI heavily in various tasks. We used it very heavily in legal, and we can get more into that later if you have more questions. We used it heavily in designing and implementing our websites and our forward-facing presence. But again, we're still using all of our engineers. They're just more effective and can do more things using the tools.
So, just to take a step back, so you were in the investment world, and then your act two was Beartooth. How did you get to act three? What was the driver? You didn't just wake up one day and go, I'm going to go look for an article from or a study from Bain. Like, you had to get there somehow. Something must have triggered in your head.
Yeah, so it's a really interesting story if you and your viewers don't mind listening. But I was
We
in
love stories.
I was in Washington D.C. January of last year, actually, for Tim Sheehy's the new senator from Montana, and Tim's a good friend of mine, a really sharp fellow. And we were there for that, and someone suggested that we go to the Smithsonian and see the Fort McHenry flag. And I really encourage everyone to go. It's the flag that flew above Baltimore during the shelling of Baltimore in the War of 1812. Well, we all know the fort didn't fall. They put the flag up the next morning, and it inspired Francis Scott Key to write the Star-Spangled Banner. And I got to tell you, again, my business partner and I saw this. We're really inspired by this. It was almost a spiritual experience on how special this is. And we walked around and we looked at some additional exhibits in the museum. And we said, look, and I'm going to say something fairly obvious, but it was impactful. We said, look, the people that built America, they were iconoclasts.
Sure.
They were different. And my partner Lauren's run institutional portfolios for 20 years. And I said, Lauren, what if we ran a portfolio of only iconoclasts? What would it do to performance? Well, about a week later, she said, look, I've got the numbers. I had to rerun them and rerun them and rerun them again because I wanted to make sure that the alpha that we were seeing actually exists, right? Because there's not a lot of free alpha left in the market. Occasionally it is there, and we think we found some. So that was number one. And then number two, the data that we needed didn't exist. You can't go to FactSet or Bloomberg and get the data that you need to do these types of analysis on when founders came in and out of their companies. So we hand-built that data set. And looking at it, we said, wow, this is really interesting. Founders really do outperform. And this is how we want to invest our own money, which we do. She and I have all of our own liquid net worth in the fund. And that's really where we got to. I said, wow, this is a mission that we can serve people and help them invest their money in a way that's very high growth, shouldn't be much more risk than or equal risk to owning the S&P 500, but over very long periods of time, you should outperform. And that's what our internal data showed. And then as we started poking around, we found the Bain study, and we found a PhD thesis written in 1980 about this, and one in the 90s, and one in 2000s. And so you start to see that this efficacy of founders has held over very long periods of time. I suspect it goes all the way back to when some of the first publicly traded shares of stock traded. We've only gone back about 30 years in detail and kind of cursory over old PhD papers, as I mentioned, from the 70s and 80s, but I suspect it goes back even farther.
Yeah, it's interesting. I was a big fan of Warren Buffett since the '80s. Made a small investment back in the '80s, and more than I loved getting the annual report. I don't know if you ever invested in Berkshire Hathaway, but you get the annual report, and it's almost like an education tool. It's not like any annual report you've ever read. I mean, it's just beautiful. Like the letter to shareholders in the front is usually like 10 pages, and he just details everything out. And I just love that about him. But he was a disciple of Ben Graham, who was a value investor. And Warren Buffett's always looked at the quality of the management team when he made investments, and it wasn't just public companies. When he made investments, when he bought like the furniture mart, the Nebraska Furniture Mart, and he bought it because of the woman who owned it, and how he just loved her, the way that she ran that business. And she was the founder, obviously. So I think you're right, it goes back even deeper to some of the you know biggest investors who also looked at this maybe in a different way, but sort of similar to what you're doing.
Yeah, I mean, we agree. I think that again, probably restating and simplifying something fairly obvious is that management is the key to how stocks perform over a very long term.
Sure.
Does the management team have the vision to look to where they need to go? Do they have the charisma and their interpersonal skills to marshal their team to do it? And do they have the execution to deliver? And again, we think that that's often shown in the founder. One of the things I think about is I envision Jensen walking down the hall late at night. I guarantee he's never walked past a piece of garbage at NVIDIA. I'm very confident he picks up every scrap of paper he sees on the floor.
Yeah, I'm sure that yeah, I would imagine you're probably correct. Um, so for some of the people that are on here, um, what is an ETF?
Awesome. So an ETF stands for E Exchange, T Traded, F Fund. So it's a specialized form of a mutual fund that trades like a single stock. So you can go to your brokerage account and just look it up. So rather than buying IBM, you just go into your brokerage account, look up FFF, and you can buy it just like a stock. They're really neat in that they're very tax efficient for the investors. The old mutual funds, you could have a fund that was down, but they had generated capital gains and you had to pay tax on it. ETFs are incredibly tax efficient. There are no taxable gains inside of the ETF until you sell them.
Interesting. So, but it's traded. Is it traded on a separate exchange? Does it have its own exchange?
They trade on New York Stock Exchange, NASDAQ, Chicago Board. So it trades, again, just like a stock on the NYSE, NASDAQ, or SIBO.
Excellent. Um, yeah. So just um, uh, just a couple of thoughts about this whole process and what you're ultimately trying to achieve. So when people are investing in the ETF, you're acting as essentially the money manager. Right? If I put money into it, am I buying shares of the ETF, or am I investing dollars into the ETF for you to manage?
I would say both. You purchase shares of the ETF. That gets, so as the money comes into the ETF, we buy more and more of the underlying shares. You own your share in the ETF, which owns a little bit of each one of the shares that we own.
So, okay. So I have Coca. So let's say Coca-Cola, right? Let's just say, for example, Coca-Cola's valuation is $2 billion, and they've got let's make the math easy. They've got a billion shares out there, so the stock's trading at $2 a share. Is that the same with an ETF? In other words, does the ETF have a valuation that says, okay, the ETF is worth, um, $250 million today, and there's, outstanding shares of 250 million. So it's trading for $1 a share. Is that essentially how it works?
Yep. ETFs work the exact same way. So if you go on Bloomberg or even Yahoo Finance or your Charles Schwab account, you'll see the number of shares outstanding, you'll see the total market cap, and you'll see the share price. So
Gotcha.
when we listed, we wanted our fund to be very approachable to everyday investors. We want that 19-year-old, say, barista who's just learning to invest to be able to, they might only be able to purchase one share per paycheck or one share every other paycheck. So we wanted to list it around $20, $25 because we want to help people all the way from the beginning of their investing journey to people who've accumulated a bit more wealth.
Gotcha. And just on a side thing, what's your take on investing in cyber currency?
Oh, things like Bitcoin?
Yeah.
So again, this is my personal view. I'm not an expert. I feel like I know a little bit about equities. I don't know much about anything else. I think Bitcoin is interesting due to its very unique attributes. I don't know anything about any of the other coins. So without I guess I'm finally, at the point in my life where if I don't know something, I just say, boy, Phil, I really don't know anything about that. So I don't know anything about other coins.
Yeah,
So
I hear you.
I know about our portfolio. I know about stocks in general. For very specific reasons, I think Bitcoin is interesting, and I know nothing about the rest.
Yeah, I think Bitcoin is interesting. Yeah, the other ones I don't pay attention to, but I think Bitcoin is interesting, and it was explained to me a while ago because I struggled for years trying to understand it. It was explained to me as it's a unified payment system. Like it's the same value anywhere you go. If you use dollars in Italy or France or wherever, it's a different valuation of dollar of the value of a dollar versus a franc versus a euro versus whatever. But you know, Bitcoin is sort of the great equalizer. So I think that that's what's interesting about it. But I just thought I'd ask, just because people, it always comes up when you're talking to investors about Bitcoin.
Yeah, I
So
mean,
yeah,
I'll just grab 30 seconds and then give the mic right back to you. I think it's about let's delve into the wider ramifications of inflation, right? I think that's a bit more interesting in that Bitcoin is interesting because there's a fixed supply, 21 million coins. And so if we live in a world where we have constant inflation, Bitcoin is an answer to that, but we also feel the same thing about investments in public securities or in a fund like ours, FFF. One of the things I explain to young people, Phil, is that I really want to help people transition from trading their time for money, which is impacted negatively by inflation, turning that time into an asset like ours, FFF, or their own home or an apartment building, and getting on the right side of inflation. So I think the larger question is, not just what do we think about coins, is how do we help your viewers get on the right side of inflation? And that is to own assets that take advantage of inflation. We happen to think that FFF is a very good one, but I'm open to other assets as well.
yeah. So do you ever see a point where you would say, okay, we have the top 100, let's expand that to the top 150 or the top 200, or would you set up another ETF?
Yeah, so this ETF has a pretty specific mandate of owning the top 100. We have a companion index. You can look up Founders on Bloomberg, which tracks the 200 largest. So certainly there could be a product built around that. There could also be a product built around some of the smaller guys, right? Because there's some interest in that. For now, we're super focused on this. Again, like I mentioned, I have close to all of my net worth in here. My partner has all of her net worth in here. We're big believers that this is a really good strategy to compound wealth over long term. But yes, we could slice and dice that data. There's some interesting subcomponents in those 200.
There are, such as, what would you?
So, yeah, so you could imagine that the largest, say 10 to 15, those are now monopolies with basically free access to capital, right? So think about if you're a well-run monopoly with free access to capital, there's some real growth in that. And then down on the smaller guys, they're not quite fighting their way through the law of large numbers yet, so they're interesting. So there's some real interesting things going on in the tails as well.
So so when you're looking at the top 100 in terms of market capitalization,
Yes.
so and so I would imagine that as new companies come out, well, I guess the determinant factor would be if a founder leaves, if a founder exits, then that makes way for another company to pop into your index.
Yes, and then also remember we do run a fundamental overlay, and so there are great companies and great CEOs that we've had the fundamental discipline to sell. For example, you asked me earlier who some of our top holdings are, and there was someone very well known, not in that was in our initial portfolio that got sold out last quarter. So we love Tesla long term. The utmost respect for Elon. He is the greatest entrepreneur ever. But that stock got incredibly expensive. I think 350 to 380 times forward earnings. So our fundamental model told us to sell it. So it got sold out, and the 101st company rolled in.
So it's not just about, so I guess I misunderstood. So it's not just about the buy and hold of the top 100. And if a founder leaves, you move that out. You're also actively trading based on information. If a stock becomes overvalued or you view it as overvalued, you can move it out and bring someone else in.
Yeah, so generally we're very long-term hold. Our average hold is around 3 years or more. Remember, we're looking at the 200 largest by market cap, so that's the pool we're fishing in. But then we do run the fundamental model where things can get moved in and out. So it's usually around 80%-ish, the top 100, but there is 20%-ish that gets variable. And so that was a great example. That was, again, we love Tesla long term, we love Elon, but our fundamental model said all other things being equal, we're going to sit this one out for a while until their earnings catch back up to their valuation.
I got it. Understood. So, oh geez, I just had a great one, and now it just left my head. Oh, so you just said, your average time for holding is about 3 years. How long have you actually been doing it? How long has the fund been live? And how long did it take you to get the fund live?
Oh, awesome. Yeah, so I should clarify on that. That was looking at historically how these would have traded would have been an average 3-year hold. We'll see what the go-forward data is. The actual fund that people can buy under FFF started trading of December of 2025, so we've got about 4 or 5 months into it. And then I think the third component of your question is how long did it take to set everything up? It took us, like we had inspiration, early January of 2025 when we were trading December of 2025. So it took us about 10 months to set things up. And I would say that we spent the first 3 or 4 months making sure that our thesis was correct. Then again, started trading capital in my own account to verify some things. And then I would say the formal process to get SEC effective, remember these are highly regulated products under the 3040 Act, really super regulated to protect the end customer. It took us about 6 months to get all of our SEC filings done. And remember, there was a government shutdown during that period as well. So we had to work through the government shutdown as well.
Is that a costly process or just a time-consuming process? I would imagine there's got to be attorneys involved.
So it's both. And back to your friend, Mr. Jensen at NVIDIA and what they're doing. Normally, your legal bills to set up a 40 Act fund, all other things being equal, be $150,000 to $350,000. Let's call it $250,000. We were tracking how good the AI models were, and when we first started, they were not good enough to draft the necessary documents. They hallucinated too much. But by about August, could have been somewhere around there, they got good enough to do it. We partnered with a really good boutique ETF law firm, but really well respected in the space with a really great partner. And we ended up drafting very efficiently. And so what used to be a $250,000 problem, we got done for about $30,000.
Oh
So
my.
that's, again, one of the things that really got me to believe there's more room from NVIDIA. If their chips can turn a $250,000 problem into a $25,000 problem. We work with Adam Parker in our past lives at Bernstein, and Adam's got a little boutique research shop. And I believe last piece I saw from him, he talks about 6x upside for NVIDIA from here. And that sounds like a lot since it's already a $4 trillion company. But when you see the value that it creates, we think there's still some room to run there.
I yeah, I mean, I'm a firm believer in AI and the value that AI is creating when used properly, uh, and so that would just translate for me into what NVIDIA is doing because that's got to be the backbone. And so, to me, I don't think we've scratched the surface. I have a friend at Johns Hopkins who is working. It's totally out of my world, but it's in the medical side, robotics for doing um, surgery. And he builds these robots that actually perform the surgery. A doctor is managing it, but he showed me the AI models to diagnose and to figure out the most efficient way to solve the problem, the medical problem that it's having. And he was showing me what they were doing 2 years ago, what they did a year ago, and then what they're doing today. And it's mind-boggling to me how much in 2 years they've learned about how to approach different problems, medical problems within a body, just from the progression of AI and the ability to use the technology that's out there. It's amazing.
Yeah, and it's such a fun learning tool too, because you can start asking it questions about a subject that you're interested in, and just the amount of iterations you can do. Should we do it blue? Should we do it yellow? Should we do it red? Oh, well, red would be in conflict with this. It's just the how quickly you can move is just really a new world. And I think it's, one thing we like to tell people is it's not. I think of it as a really eager junior employee. It still needs to be supervised. You need to check its work. Um, but if you don't rely on it as the end all be all, but really view it as a helper that you can supervise, I think it's a really powerful tool.
Yeah, I think it gets you about, in any job that you're doing, I think it gets you about 60 to 70% there. You still have to have guardrails. You still have to have human eyes on it. But, that 60 to 70% is major. It's tremendous when you start getting into certain things. And I started using it. My wife and I take Italian lessons on Saturdays, and we have an Italian teacher who's in Italy, and we get on, similar to this. But to do my homework, I started using AI, and it just sort of starts asking you questions about what do you want, what are you trying to get to, and then you start going, and it's actually been a tremendous help. I thought at first, I thought, I'm doing this, but it's sort of cheating, right? I need to do the hard work of studying, but it's actually helps me study because it takes me through a process of how to learn what I'm trying to learn quickly, which I found, fascinating, just on a human side.
Yeah, I've had the same approach. I've read the articles that AI is going to make us, dumber or whatever, but I don't believe that at all. I think it engages you, and I think it allows you to learn faster, and causes more learning, not less learning.
I agree. Yeah. The one place that I do say that I don't, and I happen to agree with some of the brands that are out there, consumer product brands that are rejecting AI created videos and created ads because it's fundamentally against, the customer wants authenticity, and you're going to feed them AI generated video AI slop, and I agree with that. I mean, we use it again. We have an advertising firm. We do marketing, but we just don't do that because it's not authentic enough. And we use it for all kinds of other things. We use it for ideation. We use it for creating scripts. We use it for all kinds of things, but not the actual creation of the video. I think that's where you have to sort of draw lines. Works really well in real estate. It works really well in industrial, but not when it comes to consumer products.
Yeah, I think that makes sense, and hopefully that's one of the benefits of automation and robotics is that we can have more real things that are handcrafted by people. There's sort of the dystopian AI that no one will have
Yeah.
any jobs, and then again back to Travis. Travis sort of turns it on his head. He said, "I think we're going to need more human workers." We kind of, I've talked to some of the younger engineers that I keep in track with, and they have that viewpoint as well. That imagine that the systems, for example, that Jeff built at Amazon, hundreds of billions of investment, I don't know, trillion what they've invested, but now a young entrepreneur with the help of Claude can basically have the same systems as Amazon. So there's the dystopian that all jobs will get killed, but there's the positive view that all of a sudden there's all these new opportunities that exist that didn't exist before.
Yeah, I agree with that part. I never bought into the dystopian. I always thought that this was another tool, just like when we got personal computers, and then we got iPhones, and it's not going to take anything away. It's going to, if you use it correctly, it's going to enhance your life, and it's going to enhance the world. But you have to use it correctly. you know so we've got a little bit of time left, so just any other parts of what you want to talk about as far as your business and FFF and how you're going about it.
Yeah, I think that it's if you have some more questions, we can chat. But I think that just kind of let your viewers know our fundamental views on investing. I think I got to it a bit earlier that we're on a mission. I want to serve everywhere from I put my end posts at a 19-year-old having their first job. I want to help them slowly build wealth. And I want a product that's stable enough so a retired 68-year-old anesthesiologist feels comfortable investing as well. And we do that by taking advantage of the fact that we have a portfolio of industries across the entire economy. What we alluded to earlier is that we're not just technology. We have a waste company in there. We have beverage companies in there. We have a few energy companies in there. And so it's a great way for people who want to invest in the markets to put their capital to work and own a product that has good growth. Something else I can pivot to if you want is to talk about growth, because one of the things that's going on right now, and we can talk a little bit or a lot, is we have the SpaceX IPO coming up, for example. And it's going to be very interesting because the NASDAQ 100 has changed their rules, and it's going to allow for immediate inclusion. And so we think people should be aware of that. And then the other thing that we want to point people to is we think that our product is still showing a lot of pure innovation, where, again, picking on the triple Qs, the QQQs, they now trade at about a 1-to-1 correlation with the S&P 500, so they're essentially the same product.
Why do you think people should need to be aware about SpaceX and the NASDAQ?
Let me drill down into that a little bit. So typically, index funds are set up to follow the pricing that's discovered by active investors, right? So you have all these active investors, whether they're at a pod shop like SAC Capital or a long-only shop like Fidelity, trying to really ascertain what a security should be worth. And you have tons and tons of market participants, and by injecting that into the markets, you get to what would be fair value at any time, given what's known in the marketplace, right? All the way back to Buffett as well. Normally, a stock won't go into a big index for months or years. I think the S&P typically requires a publicly traded company to be public for 4, 5, 10 years. They've got to have a certain number of quarters of positive earnings before they can be included in the index, because the index is relying on all these active public market investors to set the price. NASDAQ has changed the rules specifically for SpaceX so that they don't have to wait to be included. SpaceX is going to be allowed to be put into the index within 15 days. As much as I love Elon, and as much as I love SpaceX, and I'm confident that Elon will execute, there will be no time for price discovery. So we're going to have a situation where the tail's wagging the dog. The big index fund or funds are going to set the price, and active will be the price taker. So I think it's just something that people should be aware of, since it's going to be such a big event in the public markets.
Yeah, that's a bit interesting. So one last question. So you've got this fund, you've got FFF, and you on a mission. You want to make people. You want to be able to help people, young investors, older investors, etc. How do you get the message out? Like so Fidelity had funds, right? They do massive marketing to get people to understand their fund, be aware of their fund. How do you get a fund for people to be aware of?
Awesome question. And first of all, thank you to people like you that have discovered us and put us on your platforms. So I think about it in the crawl, walk, run. So in the beginning, we do a lot of reach out through forums like this. We reach out to registered investment advisors who are investing on behalf of their clients. So you're right, some of the big guys, they have a whole army of people and automated systems, but they're nameless and faceless. And one of the things we feel like we really connect with people is whether it's me or my business partner, Lauren, there are real people running your money that you can talk to and care deeply about your success, which because we ourselves are founders. So to answer your question, right now we're in the crawling or walking phase, which is doing outreach, speaking to registered investment advisors, and over time we'll be growing, getting ourselves put on platforms. So as your product matures as an ETF, various platforms, whether they be larger broker-dealer platforms or larger registered investment advisors, will put you on their platform, and the goal is to get put into their portfolio allocation, meaning if I've got to sell one advisor at a time, that's very time consuming. But if we can get an entire platform to make us 0.5% or 1% or 5% of their model portfolios, now we're starting to automate some of that growth. And back to this convergence, I'm going to talk about this convergence of, say, the S&P 500 and the triple Qs. There's really no reason for the triple Qs to be in anyone's model portfolio because they're a one-to-one correlation with the S&P 500. So if a investment advisor or a family office or an individual investor wants to upgrade their core growth portfolio, then FFF is a great place to put it. So first we start with outreach. Second, we get on platforms. Third, we get put into people's model portfolios so that they can upgrade their core growth holdings.
Yeah, fantastic. It's a lot, but good luck with that. I think it's very, very interesting. I spoke to my son about it as well, and a couple of other people, because the minute you told it to me, the first thing I did, again, I pulled that report from Bain. I read it, I understood it, and it made a lot of sense. So to me, I think it's great. We've got to wrap this up. We've got about a minute left, and I think it was a great conversation. I can't thank you enough for coming on and sharing with us. And there's a lot to take away, I think, from not just about investing, but I really think what defines exceptional founders: vision, conviction, adaptability, the ability to keep building through uncertainty, all those pieces. So I think there's a lot to take away from this for not only investors, but also entrepreneurs. So Michael, thank you again for taking the time to come on.
Yeah, thank you, Phil. And if any of your viewers have questions, I'm easy to find. Michael at founderetfs.com. The website is founderetfs.com. We're a very small boutique asset manager, so if you reach out to any of our channels, you'll get directly to myself or my partner, Lauren.
And they can find it on any investing platform, FFF.
Any investing platform, we're on all brokers.
Great. Thanks again. I appreciate it. And we'll see you next week.
Great.